Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're interviewing Bob Robotti. Bob is the president and chief investment officer of Robotti and Company. That's a value shop that has been around since 1983. He also serves as a board member for some public and private companies. Prior, he was at Gabelli and Company. He worked in public accounting before coming to Wall Street and is currently an inactive CPA. Bob holds a BS from Bucknell University and an MBA in accounting from Pace. Now, in addition, I do have to say this first. Thank you, Bob. Bob is a volunteer to CFA Society New York. He recruited all the speakers for day 2 of the upcoming Ben Graham 10th Annual Conference, which will be on June 20th and 21st. If you like what he has to say here on this podcast, you should probably sign up for that event at cfany.org. So thank you for being here, Bob.
Great. Thanks for having me here.
So I do want to start off with a question that I've asked a lot of other folks on this podcast that we talked about a little bit, was the rather unexpected declines in both the stock and bond markets in the last calendar year. And when we were talking about this, you said that you thought there was a lot of good reason for that. So could you please tell us why you think that was reasonable based on what you see?
Sure. So we've been investing for 50 years. Energy investing is part of it. When I was in public accounting, you missed that I used to audit Tweedy Brown. So my introduction to investing was, and knowing the people at Tweedy Brown, when that's who was there, was in addition to the Tweedy people, there was Walter Schloss, who had walked over from Graham Newman. There was Tom Knapp. There was Ed Anderson. So these, it is a classic old value firm.
Yes.
That is a critical part of my thought process in investing.
Okay.
So and then I've always been an investor in energy. So that's 50 years. Right, I sit on the board of 3 public companies that are energy companies, and I think that kind of like gives me a view on things. Mm-hmm. So the comment I had was, there's a quote from Bernard Baruch, and that is, "Information is no substitute for thinking." Mm-hmm. I think we're at an inflection point. What I see from my fundamental bottom-up stock research tells me there are things that are happening in the world's economy that will gain momentum and therefore be disruptive for where we are. Mm-hmm. So therefore data, especially recent data through a one cycle, because it's an odd period of time, 40 years, interest rates just went one way. They went down. Yeah. It's not even a full cycle. You haven't seen a full cycle over 40 years. That's like an unbelievable kind of fact pattern.
Right.
So I do think, so every investment, of course, first you start with your risk-free rate of return. And if your risk-free rate of return is a 10-year treasury and it's at 1.5%, everything is priced off that. Right. So bonds and stocks are all priced off an extremely low base. No margin of safety in any of that, right? Because that, theoretically, logically will not hold. Mm-hmm. And what you've really seen is disruption. So therefore, as the interest rate changes, as inflation changes, which drives interest rate changes, mm-hmm. suddenly your discount rate on everything is different.
Right.
That means every investment, fixed income, equity, everything, and of course, private equity, all of them have a different cap rate. All of them have different valuations. All of them need to adjust to potentially that new environment. So the idea that stocks and bonds would go down, to me, makes all the sense in the world, given that underlying economic change that's starting to get reflected. And for whatever it's worth, I think it's starting to get reflective, right? Because all those markets today are still predicated on inflation is coming back down to 2.5%.
Yeah, right.
That's, because there's no real rate of return in the 10-year treasury, the supposed risk-free rate of return. Right. It's not risk-free. It's a guaranteed loss based on where economics are today. So interesting times.
Yeah, it is. I was talking with someone else on the podcast about, that's the thing we used to use as the risk-free return in business school. Let's go back to the energy industry for a second, because it is undergoing some change. You have an excellent perspective on it. So what are you seeing?
My view is that the world's demands for energy in all forms is in very tight supply today, mm-hmm. and there's going to be economic advances everywhere, and therefore demands for incremental energy, and that is renewables, because clearly concern about carbon and carbon accumulations are real, and it's going to happen, and we need to spend a lot more money. So there was a Bloomberg report recently that says we need to double the amount of money we spend on renewables. Right. We need to do that through the next 40 years in order to catch up to where we need to be. Right. So there's a huge call. But in the meantime, and because of most of the world's concerned about carbon, right, the West world for sure, most of where, on the electric side, where power comes from, it comes from a fossil fuel. And so that's been substantially underinvested. Just like the fossil fuel resources itself, that industry, that portion of the power industry has been, and it's not only been underinvested, it's been shut. Nuclear plants have been shut. Coal plants have been shut. So we winnowed down, we've pared back, and we've not invested in 80%. And you can't grow 5% renewables to 10% renewables fast enough to get to 50% renewables.
Right.
So in my view, broadly, renewables, fossil fuels, because you're going to need them in the meantime, because you can't build renewables fast enough.
Or the infrastructure.
So therefore, the capital commands of both, and those are long capital intensive things.
Mm-hmm.
Of course, what I also think is that it's not just energy, it is materials broadly. Because to build out renewables, there's a huge amount of cement, steel, ships that cost $40 million to put the turbines on.
Right.
The turbines have all these materials. That's why the turbine companies lost a huge amount of money, and they continue to lose money because all the parts and components are much higher cost today.
Yes.
And as that command and demand and increasing demand on all of those resources increase, the supply can't respond fast enough.
Okay, so let me break this down a little bit because you said some very interesting things there. One of which was you mentioned nuclear. Now, nuclear, I'm not an expert in nuclear. I just do question this. 3 Mile Island, the Fukushima, and the other accidents that have happened around the world that have gotten headlines, are they really enough to stop the reissuing of licenses? We look at what's happened at Vodal. I wonder what you think about that. Is it just going to be a flat line from here?
Well, you know what I actually think the one country with the most comprehensive, thoughtful energy policy is China.
Yes.
Right. And China is building renewables as fast as they possibly can. They're also building nuclear.
Yep.
And they also, she said before the Congress last year, we will rely on our providence, and our providence is coal.
Right.
And so therefore, a year ago, it was half the world's coal was consumed by China.
Yes.
And what they did do last year, they ramped it up. They increased it to 10%, so they didn't have to use that natural gas, and they could sell that natural gas opportunistically to Europe, help Europe, and make a lot of money themselves.
Right.
But what did they do? They increased, their impact on the environment, and they continue to build new coal plants.
Mm-hmm.
So that's a country that understands the increasing demand for energy and its appetite to be able to meet that demand. They're spending money in all of those things. So it seems to me that nuclear is part of the solution because it's one of the things where you can build out. So France has made extra commitments to it.
Yeah.
Japan repeatedly, is clearly indicating an interest in bringing back on a number of those plants. Of course, you do mention 3 Mile Island. I think that's down the road. I went to school in Lewisburg, Pennsylvania, and that's in Harrisburg, Pennsylvania. And so that goes back, of course, a long time ago.
Yeah.
So actually, to mention 3 Mile Island is actually like, well, that's really not current history.
No, but I do think these things kind of book into the historical knowledge, cultural knowledge of people, right?
That's right. People have these visions in their minds that get fixed, that therefore may not be fact-based and may not be current, but yet will have a huge impact on what you can do.
Right. So so that's one thing that's interesting. The other question I have overall is there's a certain timing implementation of all this, because we do have to upgrade or build new infrastructure. We do have to create new means of creating energy. These things kind of get separated a lot. So then they kind of need to be both just in time. So what do you think our readiness is for this just in time production is?
The critical fossil fuel for the next 10, 20 years is going to be natural gas.
Yes.
And it's more than anything that critical infrastructure, because you can find natural gas. Finding new oil is problematic, I would suggest. And that's a different environment that's ever existed in human history. So I really do think that, but natural gas you could find, but the problem is when you find it, it's going to be someplace remote from where you're going to use it.
Right.
So, just like actually with renewables, as you build the new solar wind, you got to tie it in to where the people are, because they're not going to move to the middle of nowhere to put that wind farm or the solar farm.
Right.
So the transportation with natural gas, all the infrastructure you have to build, and you have to build 3 different pieces, right? You got to refrigerate it, you got to transport it, you got to regasify it.
Yep.
And so therefore, by building all of those in sequence, you're inevitably going to get that sequencing wrong.
Right.
So that will constrain the ability to respond and bring on new natural gas, which is the critical fossil fuel that's going to be needed to bridge needs. So all these things, in my mind, are going to complicate the build out of renewables and slow it, increase the cost of it,
right?
Increase the cost of all these other things with fossil fuel and the transportation of it. So there's plenty of constraints on the system and rising costs, at least for all these things, to be able to meet the world's demand.
Mm-hmm. Well, it's funny also that you said that you expect rising costs. And what do you think about consumption?
the consumption of energy.
Of energy, yeah.
In 20 and 21, in China, the consumption of coal, gas, oil, and electricity went up all 2 years.
Yes.
While the rest of the world went into hibernation,
right,
and our energy usage imploded, China didn't. It grew.
Right.
And in 2021, there were power shortages in China.
Yep.
So it already is at its limit in terms of what it can do. So its hunger is there. I also think that because of energy and because of the fact that natural gas is available in North America, North America is in a extremely favored position for at least the next decade. And that will mean this idea of how globalization changes clearly is going to change. So there already has been migration of businesses out of China. And for a multitude of reasons, including competitiveness of other places, that's going to happen as you move to Southeast Asia, as you move to India, as you go to these places. Historically, the economic inception of development, and as it moves from lower levels, the energy consumption of those places dramatically increases.
Okay.
So the energy consumption appetite for all these places that will pick up, that will be really strong. In the meantime, China's not going away. China's still going to grow as an economy. Its consumption is going to grow also. In the meantime, since things do rotate back to North America, there's a demand there too. So all this infrastructure, and it's not just an energy infrastructure, it's infrastructure of all forms, including plants. As you move around in globalization, that's a huge call on all these things that are already in tight supply today.
Okay. And as long as you mentioned North America, let's talk about Canada for a second, because I'm sure that was part of what you were paraphrasing there. The trade to the U.S., I forgot, is 60% of Canada's trade overall. Now, Canada has sort of a diverging politic from the fact that a substantial number of people there are employed in the oil and gas business, which was always a tricky thing. You saw this on the provincial level with Rachel Notley. You've seen Trudeau get it, pushing him around too, despite the massive amount of popularity he had. Do you expect the relationship between the U.S. and Canada and the policies on trade to remain sort of stable?
I do. We're so closely linked in everything. Of course, when it comes to energy, that is one of the huge positive developments for Canada, right? So Canada has always been stuck, right? Because the only place for them to export is to us.
Right. That's a good and bad news.
And especially when it comes to natural gas, since we got a lot of it too.
Right.
That's kind of like, that is not the place to be. That means you're the lowest price point. You're the most volatile. You're at the end of the stream.
Right.
The fact of the matter is two things are happening in Canada. One of them is there's a natural gas pipeline with an LNG port facility that's being built in Canada. Shell's building the facility. That pipeline will be done by the end of this year, 2023. And so therefore we'll commercialize over the next year after that. So Canada will be able to access the Asian market. Right. And of course, sailing time, it's a fraction of what it is out of the Gulf.
Yes.
And you don't have to go through the Panama Canal. So therefore, there's all these advantages. So you've got Japan right across the way with a huge appetite. So Canada has the potential to start selling in. They already do it with liquids.
Yes.
There's a couple of ports where they already export that. The other one is, of course, by the end of this year, the expansion on the Trans Mountain Pipeline is going to be done. 600,000 extra barrels a year will come from Canada and access Asian markets. So that's going to be something that's going to start to change the price point, the demand for Canadian energy, and its access to another place other than selling it just to us.
At a low
price point. So I do think over the next 3 to 5 years, that's a huge opportunity because resource in Canada is extremely long,
right?
Given all of those constraints it's historically had. So their ability to grow production is a lot greater than what it is in the U.S., I believe. All right. So there's a huge opportunity, but I still keeps them closely tied into the North American market, but it does give them some extra opportunity to access other markets.
Yeah, interesting. All right, so let's change gears to the other thing that you're a specialist in, that is home builders. There is, there must be an article in the Wall Street Journal every third day or so about people are moving from here to here. Prices are down here. Prices are up there. So what's your overall view?
Yeah. So first off, let me say right but wrong. So the home building industry is an industry that we're involved with. Home builders themselves, we almost own no home builders.
I see. Because, Your value's great.
And to a certain extent, it's I want to own the guys who sell the picks and shovels. I don't want to own the gold miner, right? Because that business has cyclicality to it. It has capital intensivity to it because you get it land, you develop the land, you sell the land, you got to find it someplace else.
Yep.
And so therefore, it's constantly rotating capital reinvestment in that business. Instead, the distributors, continue to sell product no matter where it is, has the home builders kind of move. And so that's and generally, even in energy, a lot of what we do is the guy selling the picks and shovels, not the commodity itself, given the uncertainty on where the commodity price is and therefore what the profitability of the business is.
Right.
So in home, the bottom, there's one word, demographics. What it really is there's just the demand for housing that exceeds the available supply. And so therefore you could suppress that because mortgage rates can go up.
Right.
You can suppress it because the cost has gone up, and therefore you could take some people out of the ability to kind of buy a home, but that doesn't mean you change the need for housing. And so that's what I believe, that there's a substantial demand for housing in excess of the current supply. That means you need to build new. And so that's where we think the opportunity is in supplying that fluctuating demand. But that's where we're invested, and we think there's still great opportunity there.
Okay, so let me back up for 1 second. So the rental market is doing exceptionally well all around the U.S., and it sounds like what you're saying is you would see that in a time of rising expenses on mortgages, or even the tightness that's been created recently by some of the bank failures that I assume is still out there. Is that what you're saying? Is that's an indication of?
At some point, there's going to be a rent-buy decision. And if it costs a lot more to rent because that's where people have to get their housing from, then that will influence, well, what's the price point at which I could buy a home and therefore I can replicate those economics. And so therefore, because I need to live someplace. And of course, someone who's renting is taking a huge risk, right? Because what's the repricing policy? What's the rental rate that they're going to pay over the next 20 years?
Right.
That is going to be subject to volatility. And if housing demand continues strong and the supply is limited, that means it's going to go higher.
Right.
And so therefore, if you own a home, you buy a home, you've locked in a large portion of your purchase price. And therefore,
except for your property taxes.
But there's no perfect lock in on anything. Right. But the vast majority of the numbers you've locked in. So.
Well, yeah, at the CFA Society in New York, property taxes matter. A lot of people pay pretty high ones in this area. So I guess by the by with the demographic changes, do you think there are any social demographic changes that are going to change housing anytime soon? I'm talking about now this, the trend towards people buying larger homes to perhaps make a spot for their elderly relatives to live in.
Well, it would be kind of the reverse, right? So I would think the trend continues to be somewhat smaller homes from an affordability point of view.
Right.
There clearly are some people, but of course there are these alternative dwelling units that therefore being approved or already approved in many places. So therefore that definitely is a continuing trend of putting that second home on your property. I was just in Albuquerque traveling around and looking at new homes on one of the companies I'm on the board of to get information on that. And that's what they're doing is this community, it's all the alternative dwelling unit is the incremental piece on there. And that is definitely part of providing housing for people that will create some opportunity. So that is part of the solution. The other one is, but when I say home, the home building industry generally, so we have significant investments in manufactured housing companies that actually make homes. And of course, I think that industry is extremely well positioned today.
Okay.
And even though it's had phenomenally positive returns once COVID hit, because the demand for housing was so strong, right? The demand was twice the ability of the industry to supply the homes. Okay. You can only make about 100,000 homes a year in manufactured plants.
Right.
And they were sold out 9 months backlog. And in that process, price points dramatically changed from an industry that had been under pressure for 20 years, starting in like 2003 when financing went away to that business. It had just gone down, and the pricing really had moved down. Of course, while the price of site-built homes over time had continued to go up and up and up. So the spread between what a 1,600 square foot home cost built out of a plant in a process where you supervise it and it's done, and therefore you probably have higher quality because it is in a temperature controlled, environment controlled, supervised process that you saw the people do the work. So therefore it was able to capture huge pricing and margin, but still today there's a huge spread between that 1,600 square foot home built in a manufactured plant and what it is built at site.
Okay, so make a case for it for the next 12 months.
Well, for the next 12 months, I can't guess because interest rates, economic activity, all those things will mean things ebb and flow. But I also, that's the interesting point too, and that's relevant for all the home builders, the suppliers, all of that's an industry that 15 years ago had the biggest depression probably ever, maybe even bigger than the depression, because home building really wasn't what the industry had grown up to be. So that process substantially changed the competitive and structure of many of those companies.
Okay.
So today, there are many fewer companies with very different balance sheets, with very different abilities to say, business slows down, I just moderate production back. And I have a balance sheet that enables me to, I don't have to pay debt. I don't have to do anything. I do what I want when I want.
Right.
And if I do less, that means I manage price. That means I manage profitability. That means I'm still going to make money. I'm just going to make less of it. So you see that in like the lumber business.
Yes.
So you definitely see that Builders First Source is a distributor of lumber products, which is, we had good fortune prescience to know and identify that as a real interesting industry. And so all they've done is constrain what they've done and yet kept profitability. They reported first quarter's earnings last year, and it was a blowout quarter because that's what they showed. They demonstrated, yes, in a slow environment with less activity, that doesn't mean that our earnings dramatically fall off. Yes, they fell off largely because they were at really elevated levels, but they were extremely strong today. And therefore, the sustainability in a low point in the cycle for many of these businesses is now being demonstrated, and that's very different. And therefore, it enables them to, even as you go through the volatility, it's okay. I'm going to make either good money or I'm going to make a lot of money. Right.
That's what, budget flexibility, no debt, and the ability to shift gives you basically everything you need, right?
Correct. Yeah. And so the answer to the question, what's it going to do for the next 6 to 12 months, is I don't know the answer to that. But from an economic point of view, something that I own for the next 3 to 5 years,
right,
I know I'm going to make good money in it. Yeah, my mark to market in the next year, maybe I'm down, I could even be down 20, 30% because, right, they will be volatile because the world trades based on indexes.
Yes.
And the world's trading based on indexes, based on perceptions. And therefore, the world is less efficient today than it ever was because fear and greed still exist.
Yes.
And fear and greed don't pick out individual companies, but they pick out sectors.
Right.
And they just blow out everything in sectors. So therefore, you get these movements in stock prices that really almost have their own life.
Yes.
So I think that's an interesting dynamic, which gives the stock picker. It's the world of the next decade is all about picking the right company. It's not the right index. It's the right company. No matter what the index is, there are winners and losers that are going to happen. You have to pick the right company. So I am convinced it is, the restoration of stock picking will absolutely outperform the indices, given how money moves today and how much of the buying and selling is not stock specific and is not really thoughtful. It is like a group, and it's some kind of macro trend that get overdone.
Yes.
Fear and greed can reign supreme and aren't bounded by like facts and reality in the short term.
I was going to say,
the long term, really.
They've always been like that. Well, so thank you. This has been fascinating, wildly broad. We talked about the world. So thank you. To the CFA members who are listening, as I said earlier, I'd just like to remind you that we owe Bob a big thank you for securing all those speakers for our Ben Graham event on June 20th and 21st. So please visit cfany.org to register yourself for it. And until the next podcast, I'm Rob Rowan, and I've been your host, and this has been Compound Insights.